Hi, everyone. It is great to be here. And Tyler was going to maybe pull out his phone and say 10 years ago, we didn't have this, as a way to introduce this tech portion of the day. And I was going to just mention that we didn't have the phone 10 years ago. We didn't carry our phones in our pockets 10 years ago. Not only that, but some of the tech titans at the time didn't think that it would even amount to much. So in response to news that Apple was developing its own phone, here's what some of the tech CEOs said at the time. Palms said they're not just going to walk in. RIM CEO, Jim Basile, Canadian, when someone said that this could be a sea change for the BlackBerry, he said, meh, that's overstating it. So these are now famous last words. And gentlemen, I want to ask you, had they had corporate venture capital arms, a unit of the company that was on the ground looking at the latest technology, perhaps what the iPhone and the app ecosystem could become, do you think that they maybe could have avoided their fates?
Yeah, I think I'm going to shock everybody by saying I think actually what we do for a living matters to the companies that we work for. But to make it more specific, I think last year there was on the range of $130 billion invested in venture capital, total private and corporate. Now that's a big number, but you also have to put that in perspective, which is if you think of the typical large company, it ranges of course, but probably 80% of your R&D dollars are spent on sustaining engineering and 20%. So you can multiply that 130 billion by 5 or 8 or something, because every penny of that 130 billion is focused on disruption. This is what venture people do. They look for seams, they look for markets where they can disrupt companies. And to your point, Deirdre, if you don't have somebody who's a fish in water, living, talking, starting these companies on a daily, hourly basis, you're going to get surprised by things, and surprises generally aren't pleasant.
I find it interesting that you started and said, you wanted to get right a misconception, despite what people may think you guys are actually adding to the business. Nagraj, why would we think any differently? Tell us about sort of the reputation that corporate venture capitalism has had over the years.
Well, it's not had a great reputation. I think I've talked to a lot of finance folks, CFOs, and I think it won't surprise anybody saying CFOs actually hated corporate venture capital because it was done poorly. You ended up losing money. The CFOs had to do write-downs. No CFO likes to do write-downs, I would tell you that. At least I'm not a CFO, but I don't think anybody enjoys doing write-downs. So I would say that about a few years back, maybe 5-7 years back, corporations realized the best way to do corporate venture capital is to do it like the financial VCs, but adding value to companies we invest in through the resources of the mothership, but always taking a financial first approach. So what that means is, and this is like music to any CFO's ears, because what it entails is when I or my team meets a company, we look, breathe, and feel like a financial VC. We look at it on the merits of the business. There's no points given for being a strategic, using our platform, none of that. The first meeting is a financial VC. When we invest, post-investment, we become a strategic VC. And that's a key change which has made not only new companies, but more CFOs open to the idea of having a corporate venture capital arm, because then you have a financial first focus, which CFOs like, plus the CEO and a lot of the senior product leaders are getting signal from the places like Scott mentioned, because we are at the forefront, that they wouldn't have gotten otherwise in the early stage. So the combination of that has made corporate venture capital IT better. That's the way to run it.
That sounds good, but let me ask the audience, whose company has a corporate venture capital arm here? A few Comcast people. I think that's it.
There's a few there.
A few over here.
So
I just wonder, the model seems to be shifting a little bit. A year from now, 5 years from now, are we going to see more hands in the air if I ask the same question?
Well, I think I want to reiterate one of the points Nagraj made. One of the things that's interesting about working for what is still, amazingly at this stage, a founder-led company, right? Michael still runs the company. Is when he bought EMC and I joined Dell, it was very clear. He's unambiguous, exactly this point. And we actually publish our numbers. So we are, since I'm talking to an audience of CFOs, so we're at over 3.5 times the top decile threshold for financial performance. So the reason I can't give you a specific percentile is because it's not published. They publish up to the top decile and they quit. And we're at about 3.5 times that threshold. Michael is very clear. We're a business, just like every other business in the corporation, and we produce it. But I will also tell you that this idea of strategic return is not a vague concept, right? I can point to 9 or 10 figures worth of hard measurable value that a CFO would even agree was measurable that we've returned to the company in strategic returns. So, but you don't get the latter without the former. If you don't get the financial performance of the company, they're not going to have any strategic impact. So I couldn't agree more. You must be financially led.
Now, Nagraj, I think it was you that mentioned CFOs hate corporate venture, CVC arms.
Yeah.
VCs, traditional VCs, also hate corporate venture capital. Fred Wilson, Union Square Capital, legendary VC investor based in Silicon Valley, called all CVC, corporate venture capital, dumb. He said it's a bad idea. Corporations exist to maximize interest. It's not in their DNA. How do you guys actually find deals? Do you find that there's a pushback, especially when you have these sort of storied venture capitalists telling this to startups?
Yeah, I mean, so Fred is a great investor. I think he's in New York, maybe semi-retired. But also, I think it's like saying all VCs are evil, just because you heard a few VC stories. That's like painting such a broad brush. Now, I would say that some of that, as I said, is deserved because of historically how CVCs have behaved. I would say it is absolutely not true for, I would say, the new breed of CVCs. I would say, us, Dell, I would put Comcast in that, Google Ventures. All of these are good CVCs that have financial discipline that can last a long time, but we have a longer term horizon than most VCs because ideally we want to make good financial returns, but nobody or none of our CFOs is saying you need to return this or I'm going to shut you down, because as long as we're making money and we're sort of in the top decile or top quartile, whatever the measure is, we are okay. That is actually not true of VCs. We actually have a longer term orientation than VCs have. So from a founder perspective, that plays into our strengths, in fact. When a founder comes, he or she, we don't tell them, you need to exit in 5 years, because we need to make money. We'll say, you exit when you want to exit. We will be there for you.
In fact, I'll even tell you a dirty little secret in the Valley. Some of the most sophisticated angel investors, meaning people who've made billions and billions of dollars, serial entrepreneurs that have created multiple companies with tens and tens of billions of dollars worth of market cap, they don't invest with financial investors. They invest exclusively with this new breed of corporate investors because, look, money isn't an issue. They can fund the things themselves if they need to. They want a corporate investor who has partners that are equivalent value to them as a private venture, and then they want the leverage that they can get out of the corporate partners. And in fact, I won't name the names because it'll get controversial, but we have 5 people we work with very carefully who are kind of gods in the industry who will not invest with financial investors.
Nagraj, do you see the same thing?
I'm saying there's a lot more movement towards recognizing that capital is cheap, but value add is not, which means that there is a lot more interest from not only entrepreneurs, like you mentioned, but also other wealthy angels to say, why do I need another financial VC when I can get the best of both worlds by partnering with an M12 or a Dell Capital? So we're seeing a lot of that. And to your question of, we basically, when a founder comes and asks us this question, we say, don't talk to us, go talk to other founders we have funded. And that's the easiest sale we have. Because once they talk to another founder who tells them, look, M12 did this for us post-investment. No other VC could have done it. That's it. That's the sale at that point in time. I don't have to sell. My founders sell for me.
Scott, you mentioned that Michael Dell, he looks at every deal. Is that right?
I have a brief conversation with Michael on every deal. True.
Nagraj, does Satya Nadella, how involved is he? Does he look at the deals that you make?
No, so we are set up specifically that, I'm assuming Satya has much bigger things to do than to look at what we are doing. But having said that, what he really enjoys is actually meeting these companies, because I can tell Satya what a company does. It is not the same passion as what a founder can tell what their company does. So we actually take companies to meet with Satya. In fact, we're going there next week. We take 4 to 5 companies from our portfolio post-investment to sort of say, Satya, not only is this company great, but look what they can bring to Microsoft. He absolutely enjoys those meetings because he gets very high quality signal from those.
Yeah, and by the way, that's the reason. Look, if you've been in the if you're in this industry, you're in this industry because you love technology, you love the products, you love the impact it can have on people's lives. The reason people like Satya or Michael are involved in this stuff is because they're still founders, right? They're people who grew up in the industry and they love products, and there's nothing more exciting than talking to somebody at the early stage of a company creation. It's just...
Do you have to have what would you tell a crowd who CEO has not had a CVC arm? Do you need someone who's passionate about technology? And where does CVC come from? Is it a weakness because companies aren't necessarily innovating internally, or is it a strength to see potential threats and potential targets before they get here?
So here's what the data says, because we're here in a data-driven crowd, right? The data says that 80% of private financial venture folks lose money. Okay, so all the returns go, and I don't know what the exact number is. And people debate and argue about this, but rough rule. We'll use the 80-20 rule. 20% of the people at the top make all the returns in the industry. I don't think it's going to be any different in the corporate world. So the way you get in trouble in life, whether it's in corporate life or your personal life, is to lose track of the reality of who you are, and what you do. And that's how you get in trouble in corporate venturing. Do a very cold-eyed, cold-hearted assessment of who you are as a company, what value you have to offer entrepreneurs. Be very clear about that. Hire very experienced people. Don't get cute. There are structural impediments in corporate venture. As Nagraj was saying, the average return on capital is 8 to 10 years away. The average public company CFO or CEO is in a job 5 or 6 years. If you don't have the discipline and the structure to run this thing with that long time horizon, it's not going to work. And you better have people who are super experienced and know what they're doing. Like anything in life, if you want to lose a lot of money, go find some people who don't know what they're doing, and there's plenty of people willing to take it from you.
Very uplifting. Nagraj, is there a risk in not having a corporate venture capital arm for a modern business, whether that be a tech company or a consumer company, because technologies, as we've talked about all day, are changing so quickly?
I would say that the way to look at whether it's tech or non-tech is maybe going one level up is how fast is the rate of change in your specific business. If the rate of change is measured in 5-year increments, I think you're okay not having a CVC arm because you can anticipate changes coming in.
What industries aren't facing?
I'm just saying. So to your question, yes, I mean in a lot of non-tech industries, if consumer behavior, you're sort of dependent on that and that changes quite a bit, then yes, I think it is beneficial to have a pulse on new kinds of things that are being used by consumers. Whether, I think we saw with one of the razor blade companies that have been bought and all those things where it's not a tech company, but clearly that was the way people wanted to buy razor blades. It's just a different way of doing it. So you need to have a pulse on that, otherwise you can be at the risk of disruption. But yeah, I mean, I think in general the rate of change should determine whether you need to have eyes and ears on the venture side.
Mm-hmm. And talking about that rate of change, you see consumer companies now going into corporate venture capital. Kraft Heinz, I believe, had a fund, $100 million.
Yep. 7-Eleven has a venture arm.
7-Eleven, Comcast.
Those hot dog rollers, you got to watch out for this hot dog roller disruption.
Who's coming to disrupt that? Amazon probably.
But by the way, the point really is true. Let's talk about something like AI or machine learning. What's different about when I started my career, 35, 40 years ago, 1979 in Silicon Valley, is that look, I was in this weird industry that my parents were embarrassed to say that I worked in, okay? He works for like a chip company, you know, and people thought I worked in packaged goods or something. They would say, yeah, that's what he does, packaged goods, because people knew what, you know, Frito-Lay was or something, and they didn't want to admit I worked for this funky little startup in Silicon Valley. What's different today versus that time is that tech is part of everything now. To your point about the razor blade stuff, Deirdre, it's not innovation in the razor blades, though I'm sure there's a lot of innovation on how you make the steel and all that kind of stuff. It's in the distribution platform or how you communicate with your customers. And so, you know, I do think Nagraj has a really good point, which is you can't dabble in this, right? You got to really think hard about whether you're exposed to disruption. I would guess that almost all of us are. And if you are, you got to figure out how to do it for you. You may not need a huge group. Maybe you can make do with a small group. Maybe you can make do with a very focused group. But I think having eyes and ears into the disruptions that's going on are pretty important. I mean, we can all rattle off all these industries that we thought would never be subject to disruption, right? And they are. Mm-hmm. It's a different world.
I think the only thing I would say is, riffing off, is make sure you know why you're doing it, and you have a very clear message to an entrepreneur who is coming to take your money. Because if you just say, and I've heard many people in large companies say, we're investing in the company, what are we getting? And my answer is getting equity. That's it, period. You don't get anything else. But the expectation setting is critical. Why you're doing it, what you're getting for it. You're getting eyes and ears. You're not getting any special rights. You don't get any IP. If the first time you say those things, the entrepreneur is going to run for the hills. They'll never come back, and your reputation will be tarnished. So don't ask for anything else. You invest, you're financial people, you get equity. And then you get to learn. That's the reason to do it.
I'll tell you a fun little story. You know, after Michael had bought EMC, he called me up and, you know, asked if I'd come talk to him and asked me to stay on and continue to run the group for Dell. And he said, so philosophically, explain to me, you know, where you're coming from on this venture thing. I said, look, it's, you know, you can, there's a lot of complexity like there is in anything, but at the end of the day, what you have to do as a board member is strive to be the single most value-added member of that board. I mean, basically, if you want to know what goes on in a boardroom, it's a bunch of men and women sitting in a room competing to do more for that entrepreneur than the person they're sitting next to. And if you're doing that, you're delivering. If you're not, you're not. And this was a thing back to this founder-led thing that's great. I mean, Michael just sits there smiling and, yep.
And I think you're saying that's sort of the advantage of being a corporation with other connections and businesses.
Yes,
I want to open it up for questions, but I also just very quickly want to ask both of you, what is the most overrated technology of the moment? I don't think either of you are going to say AI, but
no, it is.
You use that as your real life example. Of,
I know, but
okay. So
it is, but it is also the case. It's the most overused because every company in the last 18 months has become an AI company. Mm-hmm. Even companies, I think there's an app where you can go back on websites which didn't have AI, and suddenly they have AI there now because everything deserves a higher multiple. It's like we are old enough to remember .com, and you know when you just added a website and your stock went up, and it's the same.
For some of us, that was mid-career, not the beginning of our career.
I believe Scott even had a company, as we chatted beforehand, an AI company that was like the Office 365 of the AI world. I've also just in the last month, or last few weeks rather, heard a company, AI as a service. So,
but by the way, the AI wave by the way, I'll be the first to make fun of all the .ai companies that have popped up for all the reasons that Nagraj and Deirdre are pointing out. But I will also say something else, which is the AI is a technology. It's not a company, right? It's something that's going to infuse every product we touch. And it is as profound as the internet wave that took place in the late 90s, early 2000s. And when you touch a product 5 years from now that isn't AI enabled, I don't care if it's your coffee pot that knows that you like getting up at certain times of the day on certain weeks and is smart enough to figure out it's summer, not what, you know, they're gonna look like the 1940s car you get in at a museum and go, wow, look, it has handles on it. Isn't that cool? You know?
So is yours AI or something else?
No, AI is real.
What's the most overrated technology then?
I love technology.
Nothing? What about Libra? I thought maybe one of you guys would have said that.
Nobody's going to
We
touch
won't
that.
go there.
Right? But I would say it's not that it's overrated. It's the way companies are using it. So when people come and say, I'm an AI, I say, don't tell me you're AI-led company. Tell me the hard problem you're solving with the killer team you've assembled. And when you're successful, how big is the company going to be? But the fact that you use AI is great, but like Scott said, everybody was going to be using AI. It's like almost saying, I'm a mobile company, which everybody started saying I'm a mobile company. Now everybody has something to do with mobile. Doesn't mean you're a mobile company.
Yeah.
You're a company that's solving a hard problem. Using AI, that's great. And AI is here to stay. Don't take me wrong.
Well, I'm afraid that's all the time we have for today, but thank you very much, gentlemen. Please
Thanks.
help me in thanking Nagraj and Scott.